Insurance, Cigna Insurance, any big Bell Atlantic, any big company that was headquartered in the Philadelphia area, I managed the federal tax audit of, and I was pretty good at that. And in fact, the year I retired, I was the #1 employee in the country in large corporate audits. So the truth is, I may not know a lot about other things, but I know a lot about taxes. And the other interesting thing about myself is I have a real estate background. I am still an actively licensed broker in Pennsylvania and Nevada. I've owned tons of real estate in my day, not anymore, but in my day, I've owned tons of real estate. And so we have a lot of real estate clients. And not only can I help people from the tax side, but they'll even call me with real estate questions too, having been active and seen so much over the years. Currently, I'm in public accounting and I'm a partner with a company called Campbell Jones Cohen. We are the #1 firm in Las Vegas. We're probably the largest firm in Las Vegas. We win this dumbass contest every year as Best of Las Vegas. Now, between me and you, it's a little rigged, the contest, I'm just saying, but we win. That's all that counts, okay? Better to have a rigged contest and win than have a rigged contest and lose, okay? And so, I've worked with the Nevada corporate headquarters, by the way. I actually worked there at one time, but now we do tax work for NCH. We are, I think, pretty much their exclusive provider of tax services. And so together, I know we can help everybody out there who's listening in. So, okay, enough about me. Oh, by the way, if you have any questions, certainly send them over. But if we can't get to your questions, you're absolutely all welcome to give me a call at our office, either call NCH or call me. And I'm pretty sure I can answer just about every question you have concerning tax and real estate. So what's going to be our objectives today? Well, I think the major objective from your perspective, I think, is you all want to be successful in real estate. I mean, nobody wants to get involved in real estate and lose money, I don't believe. And so, but part of being successful in real estate too does involve federal taxes. And the reason is because real estate carries with it many positive tax attributes. It's a great deal for tax purposes. And so so the two are really intertwined together, I would say. So the first thing I thought I'd talk about is, I said how to, y'all want to be successful in real estate, but I mean, how do you even define success in real estate? I mean, I guess it depends on your involvement. If you're buying and flipping, right? Because we have a lot of buyers and flippers. Okay, I guess success would be based on how much money you're able to make when you buy and flip. And if you're buying and holding, like I did a lot. I did some flipping, but I did more buying and holding and renting. Success might be based on, I don't know, do my properties generate enough? Am I having any cash flow on my properties? Are my properties appreciating in value? And by the way, am I getting a tax loss? Because the truth is, the way, oh, look like somebody's, well, Bridget, I'm telling you, hey.
So
Thanks, Bridget. So anyway, so yeah, the way real estate should work for tax purposes is that generally it's going to generate a tax loss. And why is that? Think about it. If you bought property and you're renting it, if you have a mortgage on it, probably the majority of your mortgage you can write off because most of it is interest and taxes. And then you get to depreciate the property. You get to write it off over a period of time. If it's residential property, you write it off over 27.5 years. So the truth is, why you could have a positive cash flow because of depreciation, which is kind of like a cashless expense, you could argue, you end up showing a loss for tax purposes, and that's a good thing. That's one of the expected outcomes. Okay, so, but I think one of the first things I tell people when they're going to go into real estate is that, and I think this is important, you have to look at this like a business. That's really important, which means that you really need to take the emotion out of it. A piece of property is an investment, no different than if you bought stocks or invested in something, or you put your money in the bank. And so how you operate your business has a lot to do with how successful you are, and also has a lot to do with how things turn out for tax purposes. So this is a great time to have this little Zoom meeting, because of course it's now February. What's everybody doing now? Most people doing now. You're getting all your stuff together to do your 2022 tax returns, right? We're already starting to get a whole bunch of stuff in, right? And so everybody's putting all their paperwork together. So one of the things that I tell people to do, because you are supposed to operate this as a business, okay, you want to do the best job you can putting all your paperwork together. And what does that mean? What that means is that anything that you spend on your real estate generally is going to be tax deductible. So you don't want to forget anything, right? Right. Now, how you keep track of everything, it doesn't have to be fancy. You don't have to use QuickBooks. QuickBooks is pretty much the standard for everybody. You don't have to use QuickBooks if you don't want to. You could keep track of everything if you're using an Excel spreadsheet would be fine. You can drop all your receipts in a folder. But at the end of the day, whoever's going to do your tax return, okay, even if you're going to do your own tax return, you want to basically make sure that you're able to capture all your income. You want to report all your income, and you want to make sure that you've captured all of your expenses. And the other thing you're going to need, by the way, is you're going to need a copy of your closing statement, your HUD statement, for when you bought the property. So whether you're doing your own return or another accountant is going to do it, they're going to ask for that HUD statement, because that's how they're going to determine what the depreciation is on your property. Because don't forget, when you bought that property, it's not just what you paid for the property. You're always going to have all these settlement costs that are involved. And those settlement costs become part of what you pay for the property as well. Okay. So what everybody should be doing is doing the best job they can on putting all of their paperwork together so that someone can summarize this on a tax return. Okay. And by the way, that's no different than any other business. I want to step back one more and talk about one more thing about being successful in real estate. And that has to do with kind of putting a good team together to help you do this. Because you know what, as I found out a long time ago, you can't do everything. And depending upon where your investments are, if all you guys are in foreign countries, but your investments are in the United States, you really have to have people that you can depend on to help you manage the property, to help you maintain the property. You need a good CPA. I like to think that our firm and Nevada corporate headquarters would be part of your team. In fact, not that this is mandatory, but if you guys ever want to read a good book on being successful in business, I didn't write it, by the way, but it's a great book, and it's called Good to Great by Jim Collins. And Good to Great is a great management book, and it tells you how some companies are successful and why some companies fail. And it all has to do with being able to get the right people involved. Okay. So even if it's not us, you should have yourself a good CPA that you could rely on. Okay. So let's talk about some other issues that have come up, that always come up when it comes to real estate. And again, if you have any questions, just kind of throw them out there. But one question that always comes up is, as you're maintaining your property, what's the difference between expensing something, taking it as a write-off, okay, as opposed to capitalizing it, okay? So to start off with, the general rule is things that are more of a maintenance type thing, or things that you would normally write off. So when things break, you fix it. The pipe breaks, you fix it. That seems pretty common sense that would be an expense. As opposed to, you do major improvements on a property. So let's just say you bought a property and it was in really, really bad shape. And it cost you a lot of money to do a huge rehab project. You're adding on rooms or you're putting new bathrooms in. So larger projects like that have a kind of a longer life. Things, if you put a new bathroom in, you wouldn't expect it to break in a couple of years. You would expect it to last like a really long time. And so things that have a more permanent nature would be things that you would more likely than not want to capitalize. And what that means is instead of writing it off over 1 year, you kind of write it off over a period of years. Now, to be fair, writing things off at one time is generally a better idea. Well, why would that be? Well, because money has time value. A deduction today is worth more than a deduction 10 years from now. And so you always want to try and write off as much as you can in the current year to get a more of a tax advantage in the current year than to write it off, say, over 10 years or 25 years. So that's always our mission. So when people send us their expenses for their rental properties, we're taking a look at, what they spent money on and trying to determine whether things should be write-offable or they should be amortized over a period of years. And we're gonna help you make that decision, by the way. And so it's, even though you may start out by giving your accountant information, at the end of the day, that's something a lot of times that both of us will talk about. Okay. So that's a very, very, very common question. Not to jump around, but I mentioned earlier, what's so great about real estate and what are all these great tax advantages that go along with it? Well, think about it. I mentioned one already. For the most part, when you have rental real estate, you generally generate tax losses. Okay. Tax losses are good. We don't actually want to see you lose money, by the way. We want you to make money cash flow wise, but for tax purposes, we love losses. And why is that? Because many times, and we're going to talk about this in a little more detail, many times, okay, you can lose tax losses from real estate to offset your other income. This is a great deal. So you have a rental property that lost maybe $5,000 for tax purposes. Well, many times you could use that $5,000 loss to offset your other income, even your W-2 income. That's a great deal. Hopefully you had a positive cash flow, but for tax purposes, it showed a loss. That's great. And not all the time, we're going to talk a little bit more about that, but many times we could use those losses to offset your other income. That's a great deal. Well, what's the other great thing about real estate? Capital gains. Because when you sell real estate, while some of it that you've claimed depreciation on has to get recaptured, a lot of it can be treated as capital gains. Okay. And capital gains are good things.
Okay. Who the flip was that?
So
Sorry, my bad.
Yeah. So capital gains. Okay. So capital gains, what happens is when you file your tax return and you have capital gains on there, there's actually a separate tax calculation that's done. The IRS will figure out the tax on your regular income using one method, and they'll separately calculate the tax on capital gains. Okay. Capital gains is taxed at a lower rate. And it actually, similar to regular income tax, it's kind of taxed at a graduated rate. And what that really means is that depending upon the rest of your income, sometimes capital gains start out at zero income. If your income was low, you could have a capital gain and there's no tax on the capital gain. Then it jumps up to 15%. If the rest of your income is higher, then it jumps up to 20%. Then it could jump up to 8%. So the truth is, when I see people with a lot of capital gains, of course, that nobody likes paying tax. I get that. But the truth is, many times the tax that they pay on capital gains could be much lower than their regular tax rate. You could be in the 37% tax bracket for regular income tax, but maybe only paying 15% for capital gain. That's great. What other investment vehicle allows you to claim losses and claim capital gain rates when you sell? It's a great deal, trust me. Okay. And the best part of it is when you've held property a long time, you get the benefit of the time value of money, like I was saying before. It's a great deal. I mean, a deduction today is worth more today than it would be as a deduction, 10 years from now, or even if you sell the property and have to report the income 10 years from now, you're still way better off. So that really, I think really real estate really is set apart from a lot of other investments because of those tax attributes. Okay. All right. Hang on one second. Let me see if I could click this. Okay. I just clicked on my chat button. So let's see. So while we're on the topic of losses, again, this is the next topic is going to be one that it's a big issue, and that a lot of people don't understand it, and there's a lot of other real estate areas out there that are affected by it, but of course, not everybody tells you about it. And it has to do with this issue of passive losses. And again, I have no idea if any of you guys out there have ever done any research on this, but pretty much people's income is divvied up into two buckets. You either have passive income or active income. And active income would be, hey, you have a job. That's pretty obvious. That's active income. Or maybe you're in business and maybe you sell things. You're a retail. That sounds like it's active. Or you're a doctor and you perform services. Or you're a CPA even. How's that grab you? And that's active income. Okay, more active than I like to be. By the way, I'm looking for a job that has mailbox money. Have you ever heard that term, mailbox money? That means all I have to do is go to the mailbox and get the check. I don't have to do nothing. Okay, we're all looking for mailbox money. Anyway, so that's active income. Real estate by its nature starts out as being considered passive income. I didn't make that up. And the truth is, if you have a lot of real estate, trust me, it's anything but passive. If you manage property, and I've managed a lot, it's a full-time job. Let me tell you something. When you have crazy tenants, and I mean, it's not passive, but for tax purposes, at least, the IRS considers it passive. And the IRS has rules on how you treat passive income. And they're not all that user-friendly. Okay. And so to start out with, again, the default is it's all passive, and there's limitations on how much passive income that you can claim. And there's some exceptions to those rules, and we're going to talk about the exceptions in a second, but let's just talk about the general rules. So for most people, it's passive. Depending upon how much the rest of your income is, your passive losses are either reduced or eliminated altogether, which means that if you were making a couple $100,000 a year, say you had a W-2 job and you had rental losses, most likely you're not going to be able to claim those losses on your tax return. Now that sounds terrible, I know, and it is. But what happens then is that the losses, this is going to sound redundant, the losses are not lost forever. They're just deferred. So you can't claim them in the current year, but they carry over into future years. So say a lot of our clients, many of them that are high income, I mean, they could have hundreds of thousands of dollars in passive losses that they're not able to currently claim, They get carried over into future years. Okay. Now, so that you all don't get too depressed about this, and it's a bit depressing, I must admit. Think about it though. If you had rental property that was generating positive cash flow and you had a loss, even if you couldn't claim the loss, at least you didn't have to pay tax on the positive cash flow. So you are saving some taxes, okay? It's just that you're not getting the full benefit of being able to claim those losses. What happens? It carries over into the subsequent years. So the next big question I always get is, well, geez, Jack, what do I do with all these losses? I mean, and again, we have clients that could be carrying hundreds of thousands of dollars in losses forward. Well, they get carried forward until one of two things happen. One, you either have passive income, and guess what?
Little gremlin need to be punished.
That happens. And you know where it happens a lot on too? People that have rental properties that are Airbnb-ing them, because Airbnbs tend to make a lot more money. If everybody knows what Airbnbs are, they're short-term rentals. They make a lot more money on Airbnbs than they might on a long-term rental. So the first thing is,
I'm a greedy little gremlin. I need to be punished.
it gets carried forward into years where you either have passive income or plan B, you sell the property. Now, the truth is, most people, I would say not everybody, but a lot of people don't hold on to rental properties like for 30 years. People are always buying and selling properties. And so when you go to sell a property sometimes, and I'll give you a great example in a second, sometimes selling a property is a pretty good tax strategy. Why? What if you had a property for many years and you had accumulated all these passive losses, and now you want to go to sell it, and now you're going to have this huge profit when you sell it, okay? Well, you get to claim all those old passive losses that you hadn't claimed before. So they all come back to help you. So quite frankly, when you go to sell a rental property, sometimes that's one of the considerations. If I sold this property, what's it going to cost me in tax? And sometimes it may not be as much as you think if you have all these passive losses. The next big question I get is, what are the exceptions to the passive loss rules? That might be the number one question. So here's the IRS rule, and here's the considerations. The IRS rule says that in order to not be bound up by these passive loss rules, you have to be considered a full-time real estate professional. Well, what does that mean? Well, again, I've already explained to you that in real life, managing a couple of real properties, to me, is like a full-time job, okay? But unfortunately, the IRS defines it a little differently. And the IRS says that in order to be considered a full-time real estate professional, you're supposed to put in 750 hours a year. Now, the truth is, in the course of a year, that's not a lot. And the truth is, many times, if you have a lot of properties, most people don't keep track of it, but it's really easy to put a lot of time in. If you were to keep track of all the time that you put in, and that could be everything from managing to going to the bank, going to the post office, managing contractors, doing paperwork, doing book. The truth is, it takes more time than you think. The IRS rule says
today we're going to learn how to get a girl.
The IRS says you're supposed to put in, hey, that's live TV. Okay. So the IRS says you're supposed to put in 750 hours a year. Now, keep in mind that when you file your tax return, you can put anything you want on a tax return. What matters is what you put on the tax return, will it hold up if you get audited? That's the real issue. Listen, you can claim just about anything you want. If you get audited, will it hold up? And so if you were to get audited for that issue, the truth is that the burden would be on you, the taxpayer, to support the 750. Now, the truth is, I've represented many clients on this issue in audits. I shouldn't say this. I win a lot. All right, maybe I win all the time, but that's not the point. Nobody wants to get audited. Nobody wants to go through the aggravation of getting audited. And you are allowed to reconstruct your time after the fact. So even if you didn't keep track of your time on a contemporaneous basis, you are allowed to go back and reconstruct it. And on some audits, that's what we did. But let me give you some real life, not stories, but real life facts. So many times, I'll just say, if you have a full-time job, if you're working 40 hours a week, or you're in the military and you're putting a lot of time in at, on duty, even though you could conceivably put in the 750 hours a year, it's just a lot more difficult to believe. Does that make any sense? I mean, if you're putting in a couple thousand hours a year at your regular full-time job, I'm not saying it's impossible to prove the 750. It's just a lot more difficult. And if I was the IRS, I would kind of look at it a little more closely if you told me that. What hypothetically, of course, and this is getting recorded, so I have to be careful what I say. Hypothetically, of course, we've had situations where, say, you had a married couple and the husband, say, is a doctor, and maybe the mom is a stay-at-home mom. Well, maybe she's the one that's putting in the 750 hours, and not because she still doesn't have to prove it out on audit. It's just a lot easier to believe she could do it because she doesn't have a full-time job someplace else. And so full-time real estate is just one of those facts and circumstances thing where there is no cookie cutter answer. I would, again, sometimes you just have to use a little common sense. I would argue that if you had one rental property, it would be pretty difficult to prove you put the 750 in. If you had 10 rental properties, I'd say it'd probably be a little easier. Depending upon whether you're managing them or not, it would be a little easier, but those are the rules. So passive losses, for many people, you can't claim it. You get to carry it forward, okay? And you carry it forward until either you have a passive income or you dispose of the property, or if you are a full-time real estate professional, you can claim it right away. Now, one issue that came up, or that comes up a lot too, is that if you've been doing this a long time and you already have all these losses built up, so coming into 2022 from all the other tax years, say you have 100,000 losses that you hadn't been able to claim before, and you carried it forward into 22. Even if you meet the 750 hours for 2022, okay, that still doesn't release all of the losses from the prior years, okay? Now, we're running a little short of time, so I have to tell you an accounting joke. This is important. I should have told you this at the beginning. So a woman goes to the doctor, and the doctor has some really bad news for her. And he says to her, she only has 6 months to live. And she says, "Doctor, isn't there anything you can do to help me live longer?" And he says, "If I was you, I'd marry a CPA." And she says, "Will that help me live longer?" He says, "No, it'll just seem like it. That's all." Ta-da. Okay. Anyway, I think those are the big issues. To recap, you have to look at this like a business. It is a business, and you have to make business decisions. When you go to rehab properties, you don't want to over improve them. It's a business, okay? And you have to keep your eye on it. You can't always rely on everybody else. You can't always rely on property managers. You certainly can't rely on contractors. So if you can find good contractors, good property managers, you got to keep them, okay? And you got to try and do a good job on your paperwork, okay, for taxes. And you need a good CPA, okay? I'm not saying I'm the smartest CPA in the world. I might be, it's possible, but just saying, okay? And you need to get a good team together, okay? And somebody liked my joke, thank you. I appreciate it. Yeah, I usually start out with the jokes, you know. By the way, I'm much funnier in person. I used to do a lot of live seminars. So if I do any more live ones, come and see me live. Much funnier. Okay. All right. Okay. Do you want me to go through some of the chat questions here? If you want, I can.
Actually, Jack, if you can give me just a second, I've got a couple things to hash on
Sure.
real quick, and then we
Sure.
will open up the
Sure.
floor. So, all right. So first and foremost, for everybody, apologies for our fun guest that we had. That's the first time that I've had to deal with that before, unfortunately, but I did kick them out.
Because we're so popular. People want to come in and take over, have a limelight.
That's
how you know
you need it. All the cool people want to be here. I'm just saying, the cool people.
All right. So this is the time for questions. We've got basically another 30 minutes or so to basically talk Jack's ear off and hopefully provide some information for everybody else here. So actually, I am going to start it off because I've got a couple of questions that got posted in the chat.
Okay.
And if you guys have a question, just raise your hand and I will unmute you so that you guys can then ask Jack. And that way it's kind of, there's some semblance of organization here. So the first question that I had was, would a foundation repair be capitalized or would it be considered an expense?
I think one of the things I would look at before I decided would be how much it costs, to be honest with you. Sometimes the cost has an impact. Again, our mission is always to try and expense things, but I guess if it was a lot of money, I might consider capitalizing it, yes.
Okay.
Jack,
and wait, why are you buying properties with bad foundations? What's the matter with you? You're supposed to do a property inspection first, okay? Jeez.
Jack, I'm curious on that note. Is there a threshold in terms of dollars? Like, so if a foundation repair was like $10,000 or less, that you would consider it more likely to capitalize versus just expensing?
I don't know that there's actually a bright line test for that. I think it's kind of based on the nature of the repair. And again, you have to remember too, sometimes even if you wrote it off, it may not even make a difference. So let me give you an example. Maybe because the rest of your income was so high that you're not able to claim losses. You'd have to carry it forward. So if we capitalized that foundation repair, so we didn't write it off, and your loss was $5,000, we couldn't claim it. We'd have to carry the $5,000 off. Well, now we write off a $10,000 foundation repair. Now your loss is $15,000. Guess what? We still can't write it off. So you have to factor that in as well. Does it even make a difference on the current year return?
That definitely makes sense. Did we lose Jack?
I'm still here.
Okay. Sorry, you went, oh, people are raising hands and you moved on my screen. I was like, oh no, he's gone.
No, you're stuck with me forever, my friend.
So the other question I have, and you might have answered this one already, so apologies if I didn't hear it. Again, I was having fun dealing with our uninvited guest.
No worries.
How long can you defer losses for?
They get carried forward forever until either you have passive losses or passive income, I'm sorry, to use up the losses, or you dispose of the property. So
Gotcha.
It's not like at the end of 15 years, you lose them. No, they get carried forward forever.
Okay.
Good question.
Yeah, I think we've got a good list of questions so far. So for everybody that has contributed so far,
Hey,
thank you for that.
If this is like a game show, can I like phone a friend or use a lifeline if I get stuck or something? I don't know.
Hey, you said you were the best, so I
Well,
think we're gonna have to deny those
So
options.
even if I don't have the answer, I'm allowed to make one up, okay? Just saying.
Sure.
Okay, all right.
As the expert, you get to make your own reality, correct?
That's true, that's true.
So the next question I have for you is, do the 750 hours for real estate professional status, do those have to be directly towards your current properties, or can hours for like future properties, the ones that you're looking at or running numbers on or whatever, can those numbers be counted as well?
So I think that depends. And without realizing it, this question comes up a lot, and you've raised a good question. And the question comes up is when are you actually in the real estate business? Is it when you're still looking for your first property, or is it after you've bought a property? And so this comes up a lot because people will take, they'll take classes on real estate investing. And so my theory would be is that you don't actually have to generate income in real estate to be in real estate, but I think you have to have at least bought the first property. So what happens then is any money or any time or any money that you spend prior to actually buying a property, we'll still claim it at some point in time, but we'll claim it in a little different way. In other words, when you go take a real estate class, or, I mean, that's money that you spend, we'll call it like a startup expense. That's money that you spend prior to going into business. So but your question had to do with the 750 hours. So the truth is, if you haven't actually bought any properties yet, you're not actually in any business yet. So if you're not in any business, how could you claim a loss on it? You actually have to be in business. Well, when do you drop the flag for being in business? In my opinion, it would be actually after you buy the first property.
Okay, but after that point,
I would count anything you spend, right? That's right. It would be on the current property and even looking for new properties. I would count that in as well. Yes.
Awesome. Good to know.
Yes.
Good to know.
We actually had a guy who got audited once years ago, and he didn't have that many properties. Now, he was pretty smart because he must have looked up the rules before he did this. I think he went to Europe someplace and he wanted to write off a lot of his trip, and he gets audited, of course. And his record keeping was unbelievable. He had a record of every property he looked at, every real estate agent he met with, every single thing he did with real estate. He had it ticked and tied. It was unbelievable. I had never seen anything like this before. We won. How do you like that?
So what you're telling me, and the moral of this story, and probably the biggest takeaway from this entire presentation, is good documentation is very important.
Absolutely. Wins out all the time. Absolutely. Absolutely. But again, people are people. Nobody's thinking about that stuff ahead of time. This guy obviously had thought about it ahead of time. But the truth is, this goes back to what I said at the very beginning. You want to try and keep good records and keep track of your time. And the better job you do, the easier it is for everybody. Maybe not even just in filing the tax return, but in the worst case scenario, if you ever got hit for an audit, you just never know.
So another question that I've got, and then Erica, I will get to you. It kind of goes hand in hand with the 750 hours, if I'm reading this correctly. Somebody asked if husband and wife are both kind of working on the same project. For example, they go and physically fix the roof. And it's 8 hours of work total time, but there's two of them working on it. So does that count 16 hours towards the 750, or is that only 8 hours?
I would count 16 hours. They're both putting the time in, of course.
Okay.
Aaron,
Sweet. So
you want to be going up on the roof? Just asking. I never liked heights myself, by the way. I should tell you that. I'd go up on the ladder, but the trick is not to look down. And you know what they would tell me? Remember, I grew up in South Philly. If you fall off a ladder, don't scream, because you're going to scare everybody else. Okay. Yeah. It's not the fall one that's the problem. It's a sudden stop at the end. And so don't scream on the way down. It's only going to disturb all the other workers. I'm just saying. Still here.
Erica, I went ahead and unmuted you. So if you, your question, please go ahead.
Alrighty, so yeah, my question is, I'm doing a lot of flips and I have yet to find a way that I can avoid paying capital gains, like short-term capital gains. Is there anything you can suggest? And I'm one of those people that gets pegged at 37% on my taxes, so I'm looking for any help I can.
Wait, hold on. Wait, let me get a Kleenex here. My eyes are, I'm crying.
Hawaii is very expensive. You
I'm
can't
just telling
flip
you, you
anything
know,
under $1
I
million.
have people who come in and this guy flies in on his jet and he's complaining about how much money he's making. I threw a box.
I don't have a jet.
I am sorry, Erica. I'm just finding it difficult to feel sorry for you. I am sorry.
Wait, I'm not thinking emotionally. I'm thinking logically and lawfully. How can I
Well,
avoid
but
paying
here's,
short-term
but I
capital
gotta,
gains?
but here's the thing. This will make you feel better though. When you're buying and flipping, guess what? None of it's capital gain, ordinary or short term. It's automatically always ordinary. You're in the business. Businesses don't get capital gains. Investors get capital gains. So even if you bought and flipped it within a year, or you bought it and flipped it after a year, you're still technically not entitled to capital gains. If you buy it and rent it and then sell it, there's where capital gains kick in. But if you're buying and flipping, you're in the business of buying and flipping. That's not subject to capital gain rules. Sadi. Let me get the Kleenex out.
Okay, so there's no exemptions.
No.
How long do you have to rent it before you can sell it?
I don't know that there is, and that's a great, you actually led into another subject, which I had totally forgotten about. There is no bright line test, although sometimes they talk about a year. But the subject you actually reminded me of, 1031 exchanges, we never even talked about them. That could be a
You
subject.
can't do that with flips though, can you?
Pardon me?
You can't do a 1031 exchange on a flip though.
You can. Well, I'm saying you could. You could.
Okay.
Any investment.
Or my
property is
accountant told me we
eligible for
couldn't, so
1031.
crap.
Yeah, you could do a 1031. Yeah.
Okay, thank you.
1030, for those who are not familiar, 1031s, instead of paying tax on the year you sell it, you get to defer it into buying another property. The rules, these are one of those IRS rules that were, you know, details count. You have so many days to identify the target property, so many days to close, and you have to meet it. But basically, so here's the way this works. This is not funny, but it's funny. You're always kicking the can down the road till you die. That's pretty much it. You're better off dying with property and leaving it to your beneficiaries than selling it. The way it is. So you can continue to 1031 properties.
Jack,
All
I'm
right.
gonna piggyback on what Erica asked. So what would be the because I was also under the same impression that you could not 1031 a flip. What's the
But I don't know,
the
I don't
guidelines?
know that there would be an issue there. I mean,
Okay.
again, if you're in the business, I guess if you look at it of being in the business of flipping, maybe no. But the truth is that's one of those things. I mean, how many properties do you have to flip to be a full-time flipper? I don't know. And don't forget too, a lot of times people who flip, you know, you don't want to be locked into a 1031 either. Because remember, you only have so much time to do it. And so again, I think it falls under those categories of being like a facts and circumstances thing.
Gotcha. And obviously, with most things taxes, the specific situation for each individual
Right.
is very dependent upon the answer.
And what I like about our clients too, hopefully, is that it's a nice idea to call me with the questions ahead of time. It's really hard to, you know, the Wayback Machine, for those of you remember, was only Rocky and Bullwinkle. And so when you come to me after the fact, it's a little hard to undo things. So if you're thinking about doing something, give me a holler ahead of time and let's talk it over. You know, I used to have this theory and tell clients you need to think ahead and not back. Back is hard to do. I'm just saying. I mean, if I could go, for example, if I could go back, I would not have married my first two wives, but I can't. It's just too damn late. Okay. All right.
Kyle, I went ahead and asked you to unmute, so if you could ask your question for Mr. Cohen.
Hey, so I heard that you can front load depreciation, like you claim a couple years of depreciation when you first buy a property some way. Is that something you're familiar with?
Well, the popular thing today is called component depreciation. Or cost segregation, I think they refer to it as. And I'm pretty familiar with that, having worked for IRS a long time. It is a legitimate thing for sure. And it has more applicability to large commercial properties. Basically, what happens is that you break down a piece of property into smaller components that you can write off over a shorter period of time. So you take like a big factory building and they have conveyor, they have a whole bunch of big stuff in there. And commercial property, by the way, you write off over 39 years, but there's elevators and there's all sorts of stuff in there that an engineering firm goes in and they do an analysis and they break it down into smaller components and they write it off over a shorter period of time. What happens though is that there's a lot of companies out there that will try and tell you that you should do this on small residential properties. So the concept, the law is legit. There's no question you can do it. But as they would say, the devil is in the details. So the first thing that happens though, is these companies really never actually even look at the building. They don't. They don't. It's not like they do an engineering study. They just go in and they'll, for example, say, well, you know, the kitchen cabinets are worth $15,000. So instead of depreciating them over 27.5 years, we'll write them off over 7 years. So what happens is they basically end up upfronting a lot of the depreciation. It's a timing issue. And I'm not suggesting the timing issues are not good. They are, but you'll end up upfronting a lot of it. And so, but the problem is two problems. Number one, on audit, it would never hold up because basically they've really done no study at all. They haven't. And you're not going to come in and, you know, show me the kitchen cabinets. I know I've looked at a lot of huge kitchen cabinets. I don't think they're worth 15 grand. So the problem is it looks good. It sounds good. You can do it. You probably get away with it, quite frankly, because a lot of times you don't even save that much money. But here's the biggest problem. Here's what they never tell you. They don't tell you about the passive loss part. So again, let me go back to my example. You have a rental property. You don't upfront any of this stuff. You just play it by the book and you have a $5,000 loss. But because you're like Erica, you can't claim the loss because your income's too high. You're not allowed to claim passive losses. The 5,000 gets carried forward into the next year. So you pay somebody $5 grand to do a study, a cost segregation study. And now because you're writing this stuff off sooner, instead of 5,000 loss, it's 40,000 loss. Guess what? That's friggin' great. You still can't claim the 40 either because you're stuck with the passive loss rules. So you spent the $5,000 for nothing. They never tell you that. That's it.
Thank you.
So there is logic in there's always logic in trying to write off as much as possible. I'm not suggesting that there's not, but everybody's situation is different. And I think if there's one takeaway, I think that's the takeaway. It's helpful. The more knowledge you have, and maybe you need a little help for another set of eyes to look at things because everybody's situation is different. It is.
Right on. Thank you.
Okay. All right, Kyle. All right. What else we got coming up? So here's a big question. This is an old Steve Martin joke. How do you make $1 million and not pay any tax? First, you make $1 million. What do you think, Erica? You're already in the 37% bracket. What difference?
I agree.
Okay.
It's not too hard in Hawaii. You can do it.
Yeah, but if $1 million in Hawaii, don't go that far. That's the problem.
No.
In Hawaii, you got to make a couple million.
Yeah, you got to make it work for you, I mean, my first house, I was active duty when I bought my house here. We paid $653 for it, owned it 7 years and sold it for 1.14. And that's where I got my flipping money. Now we just flip and flip and flip and it just multiplies. But the daggone IRS keeps taking so much of it that it's, it's slowing us down.
Well, maybe I'll help you. How's that? I will. But
That
you
would be
know-
lovely.
But you know what, though, too, you raised a good point, and I tell this to people all the time. You know, sometimes what your best real estate investment is, it's your first one. It's the house that you live in. I mean, I've been a landlord, and people have rented homes for 30 years. Think about it. They could have bought the damn house 10 times over already. Sometimes a good house to start off with is the house that you're going to live in instead of paying rent. Make a mortgage payment, own the house, build up some equity, then do a home equity loan and take that money and buy a rental property. Okay. You know, that's another question I get a lot. If I buy a rental property, should I get a mortgage or should I pay cash? Would anybody care to take a guess? You borrow the money. If you do the math,
I would take the mortgage.
you go with the mortgage. That's right. Absolutely. I can give you an easy example. You had a greater rate of return when you use someone else's money.
I got another question for you, Jack. Adele, if you can unmute, you've got your hand raised, and ask your question, please.
Hi, it kind of goes along with everybody else in expenses and travel. Continuing education. So if we've already been in real estate for a while and we go to a conference, go back to the States and go to a conference for 5
Sure.
days. How much of that is actual, like something that we could write off? How much of the expense for that?
Do you already own rental property?
What's that?
Do you already own rental property?
Currently we have land that we are developing.
Not exactly. Not exactly in the bit, right? Not exactly. Well, the thing
Well,
is,
we do have a rental property in Florida as well.
okay. So, I mean, the first question I always ask when people ask me that question is, what's the predominant reason that you went on the trip? So if you're going away for 2 weeks and the class is 2 days, I'm thinking going to the class was not really the major reason you went. And so if you already have a rental property and we weren't talking about that much money, I'd probably let you have some of it as a deduction. I would. I may not let you have the whole trip, but I may let you have something. That would be fair. I mean, if you and your husband and 4 kids are going and you're staying for 2 weeks, I'm thinking probably not all of it. I'm just saying.
Other follow through question, and this one we've gone back and forth on is so we have a business in Alaska. We are foreign entity in Florida. If we're looking at properties in Washington, in order to, like, if we're traveling to Washington and I'm looking at rental properties to purchase, we don't have to be licensed in that state already as a business in order to claim?
Oh, no, absolutely not. Oh, absolutely not. That's not a requirement at all. Absolutely.
Awesome.
That's another thing we brought up that I never even talked about the use of LLCs to own property. How could I forget? Big mistake. I mean, the thing is that you don't have to do that. People do it for liability reasons, and sometimes it makes sense. I personally have been sued many, many times. I could tell you that. And the way I look at that, it's kind of like the belt and suspenders theory. That's an old saying. You probably never heard that one before. But the truth is, when you have property, of course, you're always going to have landlord policy. A lot of times I'll recommend you have like an umbrella liability policies as well. And if you really want to make sure, you'll have the rental property in the name of an LLC, and that kind of sets up a barrier between any potential liability and you losing your personal assets. And so you should think about that too.
You bring up a good segue for me, for Jack, because we've got some links on here in a little while that I'll post up, but we actually just did our last event that we did was on LLCs and asset protection.
Sure.
Adele, thank you for your question.
Thanks, Adele.
And I am going to mess this name up, so I apologize in advance. Aladino, if you can unmute and ask Jack your question, please.
Hey, how's it going? You actually got it correct. It's Aladino. But
Awesome.
my question was, back to relationship to travel. I know they're more specifically travel mode. I know us in the military, we travel all over the place and usually we pick up properties wherever our last duty station was. So when it comes to going to do your inspection, getting to look at your property, doing your landlord thing, what are some of those deductions that we can
I would allow
travel
it.
expenses?
Yeah, absolutely. If you had a property and you went there to inspect it, or you had contractors working there, and that was the predominant reason that you went, I would absolutely allow you to claim that as a deduction, of course.
Now, as far as the mode of travel, is there do we have to go through a cost-effective way? I mean, when I say that, I mean
No, not
airplane
really,
versus
but
road.
well, the IRS has a rule, and in order to be a deductible business expense, no matter what you're doing, it has to meet what they call the ordinary and necessary rule. And so if, for example, if you were in the States and you had a property in Europe and you wanted to go visit that property, and you had a choice of flying over or taking a cruise, I'm guessing the IRS might go for the plane, but they wouldn't go for the cruise. And why? It wouldn't meet the necessary part of that. Yes, it's important that you go visit it, but just because you arbitrarily choose to take a mode of transportation that's 10 times as expensive as a plane, I don't think that they would allow it. So I don't know if that helps answer your question or not. So no, it's not like the difference between coach and first class. I mean, it would be the difference between, it's a reasonable mode of transportation versus you take a private jet, let's say. Okay, so. Does that
Okay,
help
that
you?
work. Yes, absolutely. And then I did have another one, and it comes to the losses and depreciation.
Okay.
Many of us are venturing into the multifamily syndication
Oh,
and trying to
sure,
do more of that passive,
sure.
limited partner investment type of thing. One of the advertised advantages of that is that bonus depreciation that
Oh,
gets
sure.
produced. But the point of contention or the X factor that I'm trying to get over is this is usually most beneficial to the accredited and active investors. So when it comes to us, the limited partners that are just putting a couple of grand into a deal,
Sure.
how can we, if it's even possible, take advantage of those depreciations?
It's pretty difficult because, again, as opposed to you just buying a single family residence, if you're a 2% owner in a big deal, I mean, how could you put any time into that? I'm just saying, you literally have nothing to do with the management or operation of the property. So I would find it difficult to put any qualified hours in on that. And so you're right, they could have, again, and to be fair, I mean, you still want to claim depreciation, you still want to claim bonus depreciation, you still want to have losses, but as a partner, it may not have as much benefit to you as it might be to other people. There might be other partners that invest that have tons of passive income. So for them, it's a great deal. And you know what happens too, by the way, and this happened to me, by the way, because I was buying tons of property. And again, at the beginning, it generates losses. But if you own it long enough, what happens? The damn stuff starts to turn around and you start having positive taxable income. Now, what am I going to do? You know what I would do? I go out and I buy more property. So that's how I ended up with all these stinking properties. The old ones started to make money, and the only one I could shield from taxation, the way I could shield it, is to buy more property. So that's it.
That sounds like a terrible problem to have.
It's a
Absolutely terrible
problem to have. And then when I sold them, I had to pay all this tax. I'm telling you, it was awful. The ink on my check was running. It was just terrible. I mean,
I'll tell you what. I'll use the same thing you told Erica. Let me bust out my Kleenex and feel sorry for you.
yeah. Or send me. Or I tell
Derek,
people,
you beat me to it. I unmuted to simply say, let me bust out some Kleenex for you, Jack, because I can't find my sympathy.
Hold on.
I can't.
Wait a second. There's a difference between my money and your money. Okay. Watch it here, pal. Okay. All right.
All righty. let's see, Brandon, I think we've got time for one more question for all of the rest of you that if you guys have a question, if you can throw it up in the chat.
And
And I
again,
will.
if we can't get them all in, you're welcome to call me. And also welcome to visit me in Las Vegas. Because I know one of you said you were in Alaska. Let me tell you, that ain't happening. Okay, I'm just saying. If you want to see me, you got to come here. It's Vegas.
It's an easy flight from Hawaii. I'll see you soon.
Well, you know, they
Business
say that, Hawaii is very, very, Vegas is very popular with wines. What if I
Yeah,
told,
it's
wait,
the ninth island.
that's right. What if I told you a lot of my staff is actually from Hawaii? I am not making this up. My assistant Tracy, Myra, I have tons of people who work for me. They're all from Hawaii. How do you like that? Okay, what's the
I
last
believe it.
one? All right. What's that?
Brandon, I think if you can
Oh,
unmute.
and somebody else said NCH is in Vegas too. I saw that pop up. Nevada corporate headquarters. You can knock out both of us in one day. How's that? All right.
Hey, Jack, this is Brandon. Appreciate you doing this. My question is, I'm going to be separating in 2 months and becoming a GS employee under a mobility
I was
agreement.
going to ask you, separating from the service or from your wife?
Yes, active duty Air Force. Does the IRS consider federal civilian employees that
you
are on
can-
mobility agreements the same as active
absolutely.
duty?
That all counts. I work for the post office and transferred to IRS. If you work for the military and you get an IRS job, that counts. Yes.
Okay, so I can hopefully benefit from some of the capital gains, like the 2-year, like living within 10 years or so?
Oh, I
properties?
totally misunderstood where you were going. So the rule is is this the question? When you sell your personal residence,
Yes,
if you meet the 2 out of 5 rule, you get a free exemption on up to $500,000 in gain.
correct,
Okay.
correct.
However, there are some exceptions for the 2 years. If you can't make the 2 years because of a job or you get redeployed, you get there's an exception for the 2 years.
So to further that, if I did 2 years on active duty, but if I separated, turned my primary residence into a rental, doesn't that extend like to 10 years or so?
I've heard something about 10 years. I've researched this. I have found
Okay.
absolutely nothing about 10 years, quite frankly.
Okay. All right.
I really did look, and I asked other people. I couldn't find nothing. What I found was a lot of stuff on the 2 out of 5, which I'm aware of, but nothing on a 10-year rule.
Okay. Well, I appreciate you
by the way,
taking
if you see-
all of our questions.
If you see something on that, please send it over to me because I really did look. I couldn't find anything. I think what I read, people just misconstrued. It was all the 2 out of 5.
Okay. Thank you so much.
All right.
All righty. Well,
now
I think
that
that's.
I put everybody to sleep now.
Oh, I don't think you did. Taxes are the questions that get posted and asked the most because as so many people have alluded to already today, nobody wants to pay taxes, even when they
even me. No,
make
I
lots
get
of
it.
money.
And listen, it is as a citizen you have an obligation to pay the least amount possible. That's all I can tell you. And you want to get your toe up to the line, just not over it.
Yes,
That's all I'm
sir.
saying. Okay.
Well, for everybody that has participated today, up on your screen, you will see a QR code. It's a quick survey that we have for everybody. If you wouldn't mind taking a picture of that on your phone, saving it, you don't necessarily have to do the survey now, but we would greatly appreciate you guys to provide us some feedback so that we can do these events in the future, cater them to what everybody is looking for, and just generally, try to continue presenting these to everybody. If the QR code doesn't work for you, in the chat, Kyle has posted the link as well. So if you want to save that and post that or save it on your phone or computer, that would be amazing.
Okay. Can I vote? Can I vote for myself too? Is that allowable?
I don't know if voting for yourself is allowed. I mean,
I don't know. I'm just saying I could give myself a good review.
All righty. Anne, would you like to speak to this a little bit?
Yeah, sure. For those of you who have joined us and you happen to be in this part of the world, this is just to show you, you saw in the beginning our team composition, the circles that have the red is basically showing you the vacancies. And of course, with what we're doing, it requires a lot of work, a lot of resources to be able to, put together these events. And so we could certainly use other people on the team to help us with this. And so if you or someone you know are in any of these areas, and this is something you want to be a part of, please reach out to myself. I'm happy to kind of just go over what that would look like and what that would entail. And I would tell you, not only do we come together as a team to do these events, we're also kind of our own mastermind group. Each of us have experience and things that we run into in what we do, and so we use each other as sounding boards, right? So, like for example, right now, Jack, I'm actually in the process of doing my first 1031 exchange, and initially I wouldn't have even thought to do that while overseas in Japan, but I'm able to do that because I have people that I can talk to, right, to give me guidance, to give me their experience and share. And so that's been amazing. So again, if you guys know anyone in Atsugi, Iwakuni, Sasebo, Osan, in Korea, in Daegu or in Kunsan, please have them reach out to me. I'm happy to talk to them a little bit more. Back to you, Derek.
Thank you so much, Anne. As I mentioned earlier, Jack, you were alluding to LLCs and asset protections. So you'll notice down here at the bottom, how to protect an asset. That was our last event. The other two events we had were how to finance a property and how to analyze a deal. For those of you that were not able to participate in those, if you click on that QR code, it will take you to a YouTube channel that will allow you to watch those to further your real estate education. And then in closing, I'd like to thank Jack for taking your time today. I know the time difference for you is sometimes difficult, being in Vegas versus, obviously most of us are.
I'm just ready to hit the bar myself. I'm just saying.
Hit the bar. Okay.
Just saying, after a half hour of those tough questions, I need a drink. Okay.
Nice. Obviously, to all of the hosts that helped put this on, thank you. As I mentioned earlier, to everybody that's here, the background, the ADPI background is how you can identify the host. So if you have one in your location, please reach out to them and try to become part of their meetups. Or if you'd like to join our team, those are the individuals to reach out to. Anne, did you have anything that you'd like to say?
Yeah, just to note, if you look in the chat, I gave you the contact information to reach out to Jack directly. His assistant is Tracy. So I gave you contact information, so phone number, as well as the link to schedule a consult. So please reference that. So if you want to take what you learned, but you have additional questions and we're not able to, continue to capture it here, you're more than welcome, as Jack said, to reach out to him and continue that conversation with him directly.
Sure thing. No problem.
Yeah, and Jack, thank you so much. Again, for those of you who don't know, he literally took this on with like 2 weeks notice. And so to ask someone of his level, right, of experience, his breadth and depth of experience within tax season is tough. So I knew it was a tall order, but again, Jack, you're so gracious with your time and just sharing. You're definitely a stand-up guy too. I liked it. The stage for improv.
No, I liked it. I appreciate the opportunity. I love doing this stuff. So thank you.
It's a lot better than doing taxes, huh?
Absolutely. Any day of the week plus Sunday. Okay. Are you kidding me? I'm seeing 1040s in my dreams already. Okay.
Oh, Lord.
Dreams? How about nightmares?
You know how many tax returns we did last year?
How many?
About 5,000. That's a lot of tax returns.
Well, on that note, Anne, thank you very much. Jack, again, thank you for your time. For everybody else that is participating, I will leave. I'm going to go ahead and stop the recording. I will leave this up until 10:30. Jack, if you want to stick around and if anybody has questions, you're more than welcome to. But I'll leave this up until 10:30. If you guys want to network with people that are here, please take this opportunity to do so. But Jack, please don't feel like you need to stick around.
No, if you have other pressing stuff. I have a date with a beer, I think.
Date with a beer. Okay, I definitely understand. But yeah, if anybody else wants to use this time to network with individuals that are here, please take that time. And I will leave this up until 10:30 to do so. 10:30 Japan time. Apologies.
Okay. All right. Bye, everybody. Have a great week.
Thank you, Jax.
Oh,
you as well, sir.
And you have to root for the Eagles next week. That's important.
Of
okay?
course, of course.
I'm an Eagles fan from Philly. So you have to, everybody has to promise me, cross your fingers now, you're gonna root for the Eagles. E-A